Thank you, everyone. Thank you, Ms. Uma, for the introduction, and welcome to the fantastic event that has been put together by the Women's Collection. Today, I will be talking about portfolio management techniques for women. Just having a little technology challenges. I am going to share my screen with you shortly. Okay, here we go. All right, okay, I think we're good to go. So today we'll be talking about portfolio management techniques for women, closing the gender gap by investing. By now, I think we all know the statistics. In spite of the progress that has been made over the years, women still face unique challenges when building wealth. Women earn less than men, 87 cents in earnings for every $1 a man earns. And that translates into a wage gap, which leads women to have fewer dollars saved. And so that turns into a savings gap, which leads women to have less money to invest. That in itself turns into an investing gap. And with the investing gap, that snowballs into a retirement gap because women do retire with 32% less retirement savings than men do. And all of that culminates into a wealth gap. So can women close the gender gap simply by investing? I strongly believe it is possible. However, as a woman-centric advisor, I do recognize that there's an inherent dysfunction in the way women investors are advised. And today, my goal is to change that. With this in mind, my approach to portfolio design takes a thorough understanding of women's financial goals and aspirations, risk tolerance, investment horizon, as well as the unique challenges women face when growing and accumulating wealth. And what we do is translate them into actionable strategies to help women grow and manage wealth. And what I'd like to do today is to share the techniques that I use to address the negative impact of the gender wealth gap using portfolio design. So what I'd like to start first off by doing is examining what is it that women need. Just like any investor, institutional investors, the wealthiest investors, men as well, women need their portfolios to provide capital preservation. They need their portfolios to provide growth of their capital, tax minimization opportunities, and of course they need liquidity, which is the ability to access cash from your portfolio should the need arise. And what is the investment horizon that women are investing in today? Well, market growth expectations for the next 10 years are that we are going into an environment of low interest rates, low economic growth, high inflation, and stretched equity valuations. Sounds to me like the market is agnostic to women's needs. So given the lower expected returns, how should women optimize their portfolios for wealth accumulation? And so what I mentioned earlier was that there is a disconnect between how women are advised and how their portfolios are built. And recognizing that we take a very differentiated approach when a woman is sitting in front of me and we are talking about how we can build her portfolio. I start off by explaining one of the biggest challenges that we face in our industry. So what I'm looking to do at that point is really help redefine portfolio risk to women. So one challenge that we have in the investment industry is really our ability to explain risk to women. We tend to focus on market risk And one extremely pervasive and powerful stereotype that is held by both male and female advisors is that women are too risk averse, when in fact, women's excess caution is because women are less inclined, obviously, to assume high risk for the potential of higher returns than men, primarily because women prioritize capital protection over alpha generation. And what I mean by that is that, women's excessive caution, if it exists at all, could perhaps be better ascribed to their relatively disempowered status rather than biology. Already disadvantaged relative to men in the workforce, it's only natural that many women will think twice before risking what little they have. And as a result, what starts off as a gender wage gap, because we are not optimally invested, then turns into a gender savings gap. And as you saw in the previous slide, that impacts the gender investment gap, and that leads again to a retirement gap. And as you can see, these stereotypes can serve to exacerbate wealth inequalities that women is helping women really redefine what risks they face in the market aside from market risk. So there are two very impactful portfolio risks facing women that are often overlooked and underappreciated in portfolio construction. The first one is what I call the forgotten risk, shortfall risk. So shortfall risk is defined as the risk of the portfolio falling short of reaching its intended goal. And that is a very real risk for women because of the gender economic disparities that women face. They actually leave women especially vulnerable to shortfall risk. The second risk that women need to watch out for is the longevity risk, which is defined as the economic consequences of outliving a portfolio of financial assets tasked with providing lifetime income. So women face a higher risk of outliving their financial wealth. Basically, we risk living too long. So the facts are that women live longer than men by approximately 6 to 8 years. And however, we tend to retire earlier and save less. And because of that, we retire with approximately 32% less in retirement savings than men, means that to counter that, women would have to work 2 years longer to be retirement ready. And then when we are in retirement, 2/3 of long-term care residents are actually women, and 16% of senior women live in poverty. So this risk is underappreciated and very real for women. So that is why I recommend the first step being to really redefine what risk means to each woman and each client. The next technique that I look at is rethinking asset allocation. Now, I'm just going to go a little bit into what asset allocation is. So asset allocation is a portfolio technique that aims to minimize risk and maximize returns by spreading investments across various asset classes. Traditional investments include, in order of risk, cash, public fixed income, which are your bonds and GICs, and public equities, which happen to be your stocks. Unfortunately, because of the misconception and the perpetuated myth that women are too conservative and risk averse by nature, their portfolios tend to be heavily weighted, which in today's markets, characterized by low-bearing instruments, is a rather dangerous situation to be in. Women also tend to not have enough allocation to equities. And barely any allocation to private and alternative investments, which offer higher potential returns. So why is asset allocation important? Well, it is the key driver of a portfolio's returns. So it is the key driver of investment success, even more so than the individual securities that are picked and placed in a portfolio. So what we want to do is, in the process of building a portfolio, we want to be able to sit down with a woman, listen to her needs, her investment goals, risk tolerances, time horizon, and understanding the current markets as well, translate those into actionable investment strategies that can help them build and grow wealth. The resulting asset allocation built has a major impact on whether or not you will meet your financial goals. So if you do not include enough risk in your portfolio, you may not earn a large enough return to meet your goal. And if you have too much risk in your portfolio, the money for your goal may not be there when you need it. So the primary reason women and men have little to no allocation to private and alternative investments is simply due to lack of access. So recognizing this challenge at Mandeville, we've made it our mission to provide our clients with access to opportunities that would typically only be reserved for high net worth individuals or ultra wealthy individuals, should I say, and institutional investors. Private and alternative classes, refer to any asset that is not a publicly traded stock or bond held for the long term. And examples of private and alternative investments include private equity and debt, venture capital, real estate, infrastructure, resources, art, and collectibles, just to name a few. Now, I'd just like to quickly go back to the previous slide where we talked about market returns and why market returns are so important and should be a key factor to consider when building concentrated, will only return approximately 1 to 2.5% in the next 10 years, meaning that women are at an increased risk for shortfall. If we look at the heat map on the right-hand side, you'll see that the red categories, which are the categories that have the highest risk of not meeting a portfolio's objectives of a 6% nominal return, happen to be the areas where women tend to be heavily invested. Cash, investment grade bonds, emerging market bonds, high yield bonds, and even US equity, would only be returning about 4%, falling short of that 6% nominal return that an average portfolio would need. On the other end of the spectrum, we'll see that the best performing asset class happens to be private equity. And that is an asset class that is traditionally not available to most investors. In fact, if you take a look at your portfolio, what are you invested in? I would bet, and please feel free to contact me in the chat and let me know if I'm wrong, that most of you probably have an allocation that is 100% or very close to 100% in public assets. So what I'd like to go over now is what is it that we do differently? And how is it that we are able to help our clients bridge the wealth gap? Armed with an understanding of our clients' investment needs and future market expectations, we aim to bridge the wealth gap for each client, women and men, but especially for women, by optimizing their strategic asset allocation by including the standard approach, which is public fixed income, public equity, and cash, but also by providing them with access to the same high quality investments that have helped the most successful investors grow and manage their wealth. And that would be by providing them access to private equity, direct investing, venture capital, real estate, infrastructure, and resources. And interestingly enough, a recent study has shown that when women are empowered with a clear understanding of the risk-adjusted returns in the private and alternative asset classes, percentage of their capital to these two alternatives than men. So women will allocate 27%, while men will allocate only 20%. And with the pandemic, the study also has shown that with the pandemic and the challenges that women are facing, that allocation is increasing, and last year was increased by ultra high net worth women to about 55%. So at the end of the day, what I want to say is that the inherent dysfunction in the way that women are advised in terms of asset allocation tends to lead to an increase in women's vulnerability to shortfall risk and women's vulnerability to long-term risk, because they're just simply not generating enough return to meet their financial objectives and to secure their financial futures. So to move on very quickly to the next technique that we use, I would like to talk about reassessing portfolio liquidity. So that's technique number 2. Liquidity is the ease with which an asset or security can be converted into ready cash without affecting its market price. Liquidity is important when you obviously have a goal in mind for your investments, and liquidity becomes important during volatile times. So you want to have some balance of liquidity in your portfolio. So what are liquid assets? Well, liquid assets are public investments, money markets, GICs, bonds, equities, ETFs, and less liquid assets or illiquid assets refer to private and alternative investments, such as private equity, private debt, venture capital, hedge funds, real estate, art, jewelry, coins, and gold bullion. I think you start to see a theme forming there. So I want to talk about the illiquidity discount. An illiquidity discount is a discounted valuation of private and alternative investments due to the lack of marketability of private and alternative investments. So what happens is that investors are rewarded with an added premium, which is called the illiquidity premium, which serves as additional compensation to encourage investments in assets that cannot be easily and converted into cash at fair market value. Now, if we looked at, the women's portfolios and actually the portfolios of most retail investors, you will find that retail investors and public securities, which means that their portfolios are 100% liquid. And this is part of a myth that has been perpetuated. This myth is applicable to both men and women, that retail investors need 100% portfolio liquidity. And I'd like to challenge that and say, no one needs 100% liquidity all the time. So the industry, actually by perpetuating this myth is doing women a disservice by not matching up their capital allocation to their investment needs and their investment horizon. And so in recognizing that, what we do is we conduct a liquidity needs analysis. And that is essential process in a portfolio design, given that women's extended life expectancy and longer investment horizon provides an opportunity to take advantage of the illiquidity premium to maximize portfolio alpha. Why would a portfolio for a woman be designed, or a man be designed with 100% liquidity? Moving on to the next tip. So when redesigning portfolios for women, the one other thing that I tend to look at is really looking at and reevaluating investment style. So there is an ongoing debate in the markets about whether women are better served by passive or active investing. And I say, does it really need to be either or? So what is active investing? So active investing produce alpha returns, which are outsized returns, and those are above or below market returns from active investing, whereas beta returns, which are returns from passive investing. So what we believe is that both can coexist in a portfolio, especially over a lifetime of saving for major milestones like retirement. Often a prudent and skilled advisor will end up using both. And the final technique that I would like to share isn't exactly a technique. It is more of a word of advice to women. So my advice to any woman, whether you are a do-it-yourselfer or you do have a financial advisor, is to really take a look at whether or not you have been paired with the right advisor, and second of all, to look at whether or not, and advice matters. Advice matters because a recent study by Russell Investments has shown that investors that work with a financial advisor tend to build more assets. And if your goal is wealth accumulation, it makes sense to really sit down with a financial advisor and really look at whether or not you are better served working with an advisor or you are better served doing it yourself. Given the demands that I think women face in their careers and family obligations, it just makes sense for women to partner not only with a professional, but the right advisor, one that understands the challenges that you face as a woman and can put together a comprehensive action plan to help you not only achieve your goals, but to grow and accumulate wealth. At this time, I think I have raced through my presentation, and I am wondering if there are questions that I can answer and how many more minutes we have to go. So we have 4 more minutes to go. Are there any questions that I can answer in the chat or any more information that I can provide?
Well, there are no questions at this time.
Okay, can we do a quick poll of the audience? Do we have time for that?
We do not have time at this moment, so sorry.
Oh, no problem. Well, this is all the time we have today then. Thank you so much to everybody for attending. Thank you for your time this morning, and thank you to the Women's Connection for putting this fantastic event together. I hope that everybody will, receive the information that you're looking for. If you do have any questions about any of the material that I have shared, please feel free to reach out to me. I am open to having a chat, a one-on-one meeting, and happy to take any questions should they arise at a later point.